Now let's talk about fractional reserve banking system. We would like to discuss if commercial bank now has fractional reserve banking system rather than 100% reserve banking system, what will happen to the money supply? So let's assume bank will hold 20% of the deposit in a reserve and making loans with the rest. Okay, so you can see if the first household, okay, if the first person deposit $1,000 into the first bank, what happens to the reserve? The reserve should equal deposit times 20%, right? And totally we have $1,000 as deposit and then times 20%. So we will have the reserve should equal $200. And then we assume bank would loan the rest of it. Okay, so bank can make loans equal $1,000 subtract the reserve $200, which means bank now can make loans as $800. Okay, so you can see First Bank can make $800 in loans. Then you can see this is the T account for the First Bank. We have the liabilities will equal deposit equal $1,000 and the assets including two parts, right? Reserve and loans, which were equal $200 plus $800, which was exactly equal $1,000. Now, based on this information, may I ask, what is the money supply now in the market? So do you still remember when we talk about money supply? So money supply M, we said it will equal currency plus deposit, right? We know the deposit here will equal 1,000. Okay, so currency plus 1,000. And what about currency now? First Bank can make loans as $800, okay? And then we assume the person who borrowed $800 from the First Bank, actually, this person will hold $800 in currency, right? And this is what we say now the money supply will equal $800. That will be the loans, okay? The currency hold in the maybe a second person who borrowed from the First Bank plus the deposit from the first person. So the total equal $1,800. You can see the deposit, okay, depositor, okay, has $1,000 in demand deposits. And then the borrower who can hold $800 borrow from the First Bank holding currency, okay? So now the money supply will increase to $1,800. So you can see in a fractional reserve banking system, bank actually can create money, right? Because generally, we know that at the beginning, the total money supply will just equal $1,000, right? However, through this fractional reserve banking system, you can see now bank can create money, okay? Now we assume the person, okay? We assume the person who borrowed $800, who will just put this $800 into the second bank. So this is what we assume, okay? Suppose the borrowers will borrow this $800 from the first bank and then deposit this $800 into their second bank, into the second bank. So initially, let's see the second banks, okay? Initially in the second bank, it will receive the deposit, right? Receive the deposit from the second person, $800. And then we know the reserve here will equal in the second bank, okay? We will have $800, right? Times 20% as reserve, which will be 160 as reserve. Then we assume the second bank can make loans of the rest, which means now the total loan here will equal $800 subtract subtract 160, right? Which means now the second bank can make loans as $640, right? $640. So you can see in the second bank T account, initially deposit $800 and then the reserve would equal 20%, $160, and then it can make loans of the rest of it, which will be $640. So we assume now there is a person. We assume now there is a person, a third person, okay, who will borrow $640 from the second bank and then deposit in the third bank. So you can see if this $640 is eventually deposited in a third bank, then we know that in the T account from the third bank, okay, it will receive the $600 from the third person who just borrowed the $640 from the second bank, okay, and then put it as a deposit in the third bank. So the third bank, it will keep 20%. It will keep 20% as reserve, right? Which will equal $128. And then the third bank can make the loans of the rest. 640 subtract 128, which will equal 516, well, $512. Okay, $512. So you can see for the third bank, it will keep 20% as deposit and make loans of the rest. So therefore, you can notice initially, okay, initially. So the third person, so there is maybe the fourth person who will borrow $512 from the third bank and then deposit in another bank. So it goes on and on eventually, okay, you can see originally we have the deposit just equal $1,000, right? And through the second bank, okay, the first bank can, so through the first bank, it can make loans of $800, right? So $800 will hold currencies in another person's hand. And then through the second bank, it can make loans as $640. Through the third bank, it can make loans as $512. And then eventually, okay, then we can find out the total money supply. Eventually, we can find out the total money supply will equal eventually through the fractional banking system, fractional reserve banking system, okay, eventually the money supply will equal $1,000 divide the reserve ratio, okay, which will equal $1,000 divide 0.2, which will be 20%, right? So finally, through the fractional reserve banking system, we know the money supply eventually would increase to $5,000. So this is what we see in the fractional reserve banking system. Actually, commercial banks can create money, because originally they're just $1,000 in deposit, right? However, through this fractional reserve banking system, eventually can create the money supply to $5,000. A fractional reserve banking system can create money, but it doesn't create wealth. It creates money, of course, but it doesn't create wealth, because bank loans will give borrowers some new money and also an equal amount of the new debt. If you borrow $800 from the first bank and then put those $800 in the second bank, actually you create the money supply. However, the banking system creates the money supply. However, you owed $800 to the first bank, right? So this is what we say. Through the fractional banking reserve banking system, it does create money. However, it also will create an equal amount of the debt. So the creation of the money by the banking system increases economy's liquidity, but not the wealth. Okay, not the wealth. This is very important. Okay, and then let's move on to talk about money multiplier. So what is the money multiplier? How can we compute this? Money multiplier is just the amount of the money the banking system can generate with each dollar of deposit. With each dollar of deposit, then the amount of the money that banking system can generate, which would just equal 1 over reserve ratio. So this is what we call the money multiplier. Okay, so I'll just write it down here. Money multiplier. Okay, multiplier would just equal 1 over reserve ratio. 1 over reserve ratio. And then in this case, okay, in our example, we have reserve ratio equal 20%, right? So you can use 1 over 20%, which will equal 5, right? So we have the multiplier here will equal 5, which means $1,000 actually can generate $5,000, okay? Can create $5,000 in money supply. Okay, so up to now, we talk about three different banking system, right? We're talking about three different scenarios. The first scenario is no bank, which means the money supply will be exactly the same as the original deposit, right? And then we move on to talk about 100% reserve banking system, which will still have the money supply equal to the original deposit, $1,000. However, through the fractional reserve banking system, actually commercial banks can create money, and then the commercial banks can create money equal money multiplier times the initial deposit. So money multiplier here times the initial deposit, which is the amount of the money that commercial bank can create. Now let's move on to the second part of this chapter, Federal Reserve. Okay, we know that reserve ratio are required by Federal Reserve. And what is Federal Reserve? Actually, Federal Reserve is the central bank of the United States. Okay, so let's look at the Federal Reserve. Most of the time, we abbreviate it as Fed, aka Fed. Okay, it's the central bank of the United States, and then there are three responsibilities for the Fed. The first one is Federal Reserve is the agency that will conduct the monetary policies, like increase the interest rate, decrease the interest rate. Okay, etc. Like the open market operations or increase the reserve ratio or decrease the reserve ratio. Those are what we call monetary policies. And then the Fed is also the central banking system and it also will make the bank regulations. Okay. The current chairman of this Fed is Jerome Powell. Okay, so you probably will hear his name a couple of times during the economic meetings or during the Fed meetings, especially these days when the interest rate will increase to fight the inflation. Okay. Now for the Federal Reserve System, let's look at the structure. Okay, it will include the board of the governors. So there are seven members. There are seven members in this board of government, and then the board of the government. This board was located in Washington D.C., including seven members. It also has 12 regional Fed banks. 12 regional Fed banks located around the United States. So, for example, in Oregon, this area we belong to the Federal Reserve Regional Bank in Seattle. Okay, in Washington State. The Federal Reserve banking system also including a very important committee, which is the FOMC, always abbreviated as FOMC. You might hear this word pretty often during this special economy time when we talk about FOMC. We'll do something to to shrink the money supply in the market and then to control the to fight with the inflation. So FOMC, Federal Open Market Committee, is a very important committee to control the money supply, and it includes the board of the governors and the presidents of some of the regional Fed banks. And FOMC decides the monetary policy. Okay, this is a very important committee from Federal Reserve. Now let's look at some roles of the Federal Reserve. First one, as we know that Federal Reserve is the central bank of the United States, right? So the Federal Reserve is the bank for all banks. The bank for all banks. Offers supports and stabilities for the banking systems. So it will try its best to fight with bank run and then to keep the stability of the commercial banking system. The federal funds, let's look at federal funds. Federal funds means the private bank, or we call it commercial banks, they can deposit at the Federal Reserve. Okay? And when those commercial banks deposit their money into Fed will offer the interest rate for those federal funds. So the interest rate or the law, this is the interest rate that can give to the federal funds, or if commercial banks want to borrow money from Federal Reserve, you also need to pay those interest rates. Okay. And those were negotiated between the private banks, not set by the Federal Reserve. All right, now let's see. There are some roles of the Federal Reserve. We know the Federal Reserve can offer discount loans. What is discount loans? Discount loans will be from Fed to the private banks. So if the commercial banks want to borrow money from Federal Reserve, and this is what we say the Federal Reserve can make discount loans. And Federal Reserve will act as the lender of the last resort. So if the commercial banks will run out of the money and then he cannot find other banks to borrow money, then probably it can turn to Federal Reserve for help. However, discount loan is not used frequently. Okay? But reassuring during crisis. Reassuring during the crisis, especially during the financial crisis in 2008, Federal Reserve did make a lot of discount loans to commercial banks, try to support those commercial banks away from bank run. Then what is discount rate? Discount rate is the interest rate on discount loans. So if the commercial banks borrow the discount loans from Federal Reserve, then it need to pay discount rate. So you can see, so here I just wanted to ask you a question. Okay, if the Federal Reserve lower the discount rate, it will encourage the commercial banks to borrow money from Federal Reserve or not? Of course, yes, right? So if you can see the Federal Reserve can control the money supply through this discount rate. So if the Federal Reserve will increase the discount rate, then it will discourage commercial banks to borrow money, right? And that can decrease the money supply. However, especially you can notice if you check some data before, during the financial crisis, the discount rate was really low, which will encourage commercial banks to borrow money from Federal Reserve and then increase the money supply. So let's look at another one. Federal Reserve also will make the regulations and rules for commercial banks. So it will set and monitors the requirements, try to reduce the risk. All right, now let's look at this graph. You can see for households like us, okay? Households and firms, they can put their deposits, right? They can put their deposit in commercial banks. And then commercial banks can also make loans to firms and corporations and households. So for example, for me, if I bought a house, right? And then I need to make a mortgage loan. I will find a commercial banks who can make loans to me, right? And if I have extra money, I can put my extra money as the deposit or into my saving account in the commercial banks, right? And then for commercial banks and Federal Reserve, you can see commercial banks, they need to put the federal required reserve into Federal Reserve. And then if it has a extra money for the commercial bank, it can also put some private funds into, you can put some federal funds into Federal Reserve. And Federal Reserve can also make discount loans to the commercial banks if it needs. Now let's look at the monetary policy tools. As we just talked about, FOMC, Federal Open Market Committee, is the important committee to control the money to conduct the monetary policies, right? And one of the important monetary policies is through the open market operations. So open market operations now is the primary single tool of monetary policy. And we will talk about this in details in chapter 21. Okay. So here we just have some general introduction about this open market operations. So Federal Reserve will create a new version after the financial crisis. The secondary tools were from the reserve requirements and discount rates. So you can see there are two different types of tools Federal Reserve can use. Primary tool is through the FOMC, the open market operations. And then the second tool is to regulate the reserve ratio and discount rate. You can see that in 2008, because of the financial crisis, right, Federal Reserve implemented 9 new monetary policy tools. And we will talk about this in details when we move on to chapter 21. Let's look at something that can do through the open market operations. So in the open market operations, you can either purchase or sell the bonds by the central bank. Okay, so this is the major tools for the open market operations. Buy, let's see, purchase bonds or sell bonds. Purchase bonds or sell bonds. What are the difference between these two operations? So you can see if Federal Reserve decided to purchase bonds, those bonds generally, okay, they are the U.S. Treasury of Securities. So we'll take it as those bonds here, generally referring to the U.S. Treasury securities. So if Federal Reserve decided to purchase bonds, so purchase bonds means Federal Reserve can buy those bonds from commercial banks. If most of the commercial banks, they will have the U.S. Treasury securities in their assets. Okay, so Federal Reserve if try to purchase those U.S. Treasury securities from commercial banks, if you buy something, you need to give money to that person, right? So you can see you can act as Federal Reserve like one person, and then there is another person as commercial banks host the U.S. Treasuries. Federal Reserve going to buy the U.S. Treasury securities from commercial banks, which means Federal Reserve should give money to those commercial banks, right? So purchase bond means give money to commercial banks. Inject, sometimes we'll say inject money. Give money to the commercial banks, right? Because you want to Federal Reserve want to buy something. Buy something means you need to pay people money, right? So Federal Reserve, if it decided to purchase bonds or buy securities, means give money to the commercial banks, and this will increase money supply. Increase money supply. How about the opposite? Sell bonds. So Federal Reserve decided to sell U.S. securities. Then the commercial banks, they can buy the U.S. securities from Federal Reserve, right? So if you sell something, which means you collect money from commercial banks, right? So means collect money from commercial banks. Commercial banks. You will collect money from the commercial banks, and that will result in money supply decrease. Okay, it reduce the money supply. So sell securities will decrease the money supply. And why we will use the treasury securities? Why Federal Reserve will use the treasury securities as the bonds? Because the funds will go directly, firms, the money will go directly into the loadable funds market, and then it can buy and sell large volumes daily, like 500 billions, 500 billions per day. So that will be easier for Federal Reserve to control the money supply in large volume. Okay, so this is the open market operations. You can see for the open market operations, this is the purchase. Okay, purchase the bonds, which means it will increase the money supply. And then we talk about this type of the monetary policy is expansionary monetary policy. So you can see through the purchase, okay, through the purchase bonds, then there are more money will be available, more money supply will be available in the market. In the open market operations, if Federal Reserve decided to sell bonds, which means it will use the contractionary monetary policy, which will reduce the money supply. Okay, will reduce the money supply. So this will reduce the money supply. Now let's look at the second type of the tools. Open market operations are the primary tools. Sometimes Federal Reserve can also use the reserve ratio or discount rates. So the reserve requirements is one of the additional tools that Federal Reserve can sometimes use. So if the Federal Reserve increase the reserve ratio, what will happens? We know that reserve ratio can transform to the money multiplier, right? And money multiplier would definitely affect the money supply. So if Federal Reserve try to increase increase the reserve ratio will actually decrease the money multiplier, right? Decrease the money multiplier, and which will reduce the money supply, which will reduce the money supply. And if the Federal Reserve decrease, decided to decrease the reserve ratio, which will, if this one decrease, and then the money multiplier will increase, right? I would say money multiplier increase, and then finally it will increase the money supply. Okay, so through this way, Federal Reserve can also control the money supply. So you can see here through this table, okay, we have the reserve ratio on the first column, and then the money multiplier in the second column. You can see as the reserve ratio increase from 5% to 25%, the money multiplier will decrease from 20 to 4. Okay, so you can see through this one, actually, Federal Reserve can control the money supply in the market. Now let's look at the discount rate. So discount rate It's very similar to the reserve ratio. So when the discount rate increase, actually it will discourage commercial banks to borrow money from Federal Reserve, and which will reduce the money supply, right? However, if the discount rate decrease, then it will encourage commercial banks to borrow money from Federal Reserve, and which will definitely increase the money supply. So the discount rate is the interest rate charged on loans to banks from the Federal Reserve. So Federal Reserve will increase the discount rate, which will discourage borrowing, right? And then reduce the money supply, right? So discount rate always used very actively during the Great Depression in 1930, okay? But now it's not a very popular policy tools because it's too strong. If you just like the reserve ratio, if the Federal Reserve decided to increase or decrease the reserve ratio or the discount rate, it will affect all the commercial banks. It will affect all the commercial banks. However, through the open market operations, commercial banks they have their own choice to participate, buying or selling the bonds or not. Okay. However, if a reserve ratio or discount rate is too powerful, it will affect all the commercial banks. Okay, now let's look at some additional informations about these days. From here, I'll just give you some informations about QE, QT, or taper. Okay, so first let's look at quantitative easing, always abbreviated as QE. Okay, so at the end of the 2008, it will be the worst quarter in United States economy in 50 years. And then the real GDP decreased by 8.9%. Unemployment was up really high. Okay. So Federal Reserve decided additional measurements really needed. And then it decided to imply QE, okay, quantitative easing policy. So quantitative easing is will be substantially expand the size of the Federal Reserve balance sheet. Do you still remember the balance sheet? We have the liability, we have the assets, right? So this QE will substantially expand the size of the Federal Reserve balance sheet, and the target of using open market operations where the central bank can buy securities in certain markets. So look at this one. When central banks decided to buy securities, what does it mean? Buy securities means you will give money to the commercial banks and which would substantially increase the money supply, right? So it will increase the money supply. This is what we call it QE, okay? QE. Buy a lot of securities from commercial banks and then increase the money supply and also lower the interest rate. The interest rate during the 2000 after 2008, the financial crisis, the interest rate was nearly equal zero. Okay, which means if there are firms and corporations borrow money from commercial banks, the loan rate was really low. Now let's look at another concept called taper. What does it mean, tapering? So tapering is the reversal quantitative easing policy. It's not like a total opposite, but it's the slowing down of QE, slowing down tour of QE. So tapering may include charging the discount rate or changing the discount rate or reserve requirements. In the United States, the Federal Reserve will also reduce its excess holdings. So what does it mean? It will reduce reduce the speed of purchasing bonds, reduce the size of purchasing bonds, which will decrease the size of the money supply. So tapering is just like the middle, okay, transit from QE to QT. We'll talk about QT later. Essentially, it is the term used to describe the process whereby the excess purchase implemented by QE are gradually cut back. So as we just talked about for QE, commercial banks or no, not commercial bank, the central bank or Federal Reserve try to buy a large volume of securities from commercial banks, right? To try to inject as many money as possible to commercial banks and increase the money supply to boost the economy. However, tapering means the central bank will reduce the amount or the size of the purchasing securities and then try to cut back the QE policies gradually. So financial markets might experience a downturn in response to tapering. This is what we said, the tapering tantrum, okay? Now let's talk about quantitative tightening, QT. So probably you'll hear QT, QE tapering these days very often, okay? So QT is the opposite of QE. So QE means commercial banks will buy securities, right, and increase the money supply. So QT means now the commercial banks will sell the securities, sell the bonds, and then reduce the money supply. So QT refers to monetary policies that contract or reduce the Federal Reserve balance sheet. The Federal Reserve will implement QT by either selling the securities or letting them mature and removing them from its cash balances. So on May 4th, 2022, this is very recently, okay, the Federal Reserve announced that it will embark on QT in addition to increasing the federal funds rate to put the size for all their economics, put the size to the commercial banks of accelerating to fight towards the inflation rate. So when you can see when the Federal Reserve increase the federal funds rate, what will happen? What is federal funds? As we just talked about, federal funds are the funds that the commercial banks can deposit into the Federal Reserve, right? And then the federal funds rate, if Federal Reserve increase the federal funds rate, it will definitely decrease the borrowing activities from commercial banks. So it will reduce the money supply. The main focus of the current QT is to reduce the amount of the money in circulations so as to contain the escalating inflation forces. Now we know the United States face a very serious inflation rate, right? Even in this month's just released inflation rate as high as 8.3%, which is still higher than people's expectations. So the process by QT, okay, is done by increase the interest rate. Okay, increase the interest rate. Okay, so I think those are some informations for this chapter. So first we talk about the how commercial banks can create money, right? And then we introduce Federal Reserve. So hope you will enjoy this chapter. Thank you.